As you've seen, investments are measured at fair value with changes in fair value recognized through the statement of operations. Seems simple and consistent enough, but are there other issues worth mentioning? You better believe it. ASC Topic 946 provides some specific guidelines when it comes to the initial measurement of investments, including the timing of initial recognition and the treatment of transaction costs. Let's take a closer look at both of these issues. As for the timing of initial recognition, there are two primary dates typically surrounding the acquisition of an investment: the trade date and the settlement date of the transaction. The trade date is the date in which the order to purchase the investment is placed, typically with a broker. On this date, the quantity of the investment purchase and the price to be paid is agreed. The settlement date is, as the name suggests, the date in which the transaction is settled. The investment is delivered to the buyer, and the consideration is transferred from the buyer to the seller. In accordance with ASC Topic 946, investment companies are required to account for purchases and sales of investments on the trade date. This means that when a transaction is initiated to make a purchase, the investment is recognized on the buyer's statement of assets and liabilities, with an offsetting entry to payable to broker for the transaction price. Any unrealized gains or losses occurring between the trade date and settlement dates are recognized as if the investment was physically possessed during that period. And what about those brokerage fees and other transaction costs incurred to buy or sell investments? While the definition of fair value under ASC 820 clearly states that transaction costs are generally omitted from a fair value measurement and recognized through expense as incurred, investment companies under ASC Topic 946 have specific guidance regarding initial measurement and subsequent measurement, resulting in a unique way these costs are presented. Let's assume a fund purchases an investment with a fair value of $1,000 at the time of acquisition. As part of this purchase, it had to pay a $25 brokerage commission. ASC 946 requires that the initial measurement be based on the transaction price, which includes those commissions. However, immediately after the purchase, subsequent measurement is required to be recognized at its fair value. This results in a measurement at the end of day one of $1,000, and a payable to broker would be booked for $1,025. For most companies, the difference of $25 would be recognized as a commission expense in the income statement, but not for an investment company. An investment company is explicitly required to recognize this $25 commission as part of its unrealized gain or loss on the investment. This means that on initial recognition, or day one, the fund would already have an unrealized loss. These two issues surrounding initial recognition have illustrated some of the unique accounting and reporting issues for investment companies as it relates to investments. There are also some unique issues related to initial and subsequent accounting of investments, depending on the type of investment held by the fund. There are three main categories of investments: equity securities, debt securities, and alternative investments. Each of these types carry unique attributes and accounting considerations, which will be discussed in this course, including investment income recognition, foreign currency treatment, as well as a few others.